Dear Dr. Jordan, dear Professor Rajan, dear Miss Rajan, dear ladies and gentlemen, dear colleagues of ETH Zurich, my name is Ulrich Weidmann. As Vice President of ETH Zurich, I would like to welcome you on behalf of the Executive Board of our university. The event of Swiss National Bank is a great honor for us because it will further strengthen our close relationship with this institution. Now, society and economy have always been in strong interaction and dependence. But for the first time in history, all parts of the world are linked in real time, and never before international trade achieved today's volumes. And again, our world is faced with unbelievable poverty and huge differences in many societal aspects. This leads not just to huge consequences of economic crisis and a much faster propagation. Probably it leads also to new forms of risks. Reason enough for ETH Zurich to develop strong the research fields of economy and society-related risk research. Therefore, not surprisingly, the relations to Professor Rajan to ETH Zurich are threefold. First, he was one of the few economists who warned for the risk associated with the financial deepening as it occurred prior to the financial crisis. This underlines the importance of independence of research in general. Second, Professor Rajan has examined whether the private sector can ensure an economy against bank crisis. At the ETH Zurich Risk Center, scientists have developed similar ideas and models for such capital insurance. They also concluded that it is difficult to obtain complete insurance. And third, inspired by the research of Professor Rajan, large research projects under Professor Gersbach and Wattenhofer investigate the deep foundations and properties of our monetary architecture in which banks can create money in form of electronic deposits and loans. A further topic is the question whether central bank digital or cryptocurrencies could improve our monetary system. Thanks to Swiss National Bank, this outstanding event takes place yearly at ETH Zurich and underlines the tight relations between the two federal institutions. The event makes part of several other strong cooperation, and they reflect common values such as independency, security, stability, reliability for society and economy. I would like to thank Dr. Thomas Jordan and his team for choosing ETH Zurich for the yearly Karl Brunner Distinguished Lecture. And I would like to thank Professor Rajan for visiting Zurich and giving his lecture. I wish all of us an insightful, inspiring evening and hand over to Thomas Jordan.
Ladies and gentlemen, I'm very pleased to welcome you all to this year's Karl Brunner Distinguished Lecture. This occasion marks the 30th anniversary of Karl Brunner's death. In the Karl Brunner Lecture Series, the Swiss National Bank pays tribute to academics whose research is of particular relevance for central banking. Today, we are celebrating the outstanding contribution made by Raghuram Rajan, the Catherine Dusac Miller Distinguished Service Professor of Finance at the Booth School of Business at the University of Chicago. We are honored that Dr. Rajan has accepted our invitation to deliver this lecture. Raghuram Rajan was born on the 3rd of February 1963 in Bhopal, India. He started his career with a bachelor's degree in electrical engineering from the Indian Institute of Technology in Delhi. Following the decision to leave the sphere of electromagnetic fields and waves in favor of the oscillation of the economy and financial markets, Raghu joined the doctoral program at the Massachusetts Institute of Technology, where he received a PhD from his thesis, Essays on Banking. 4 years later, at the age of just 32, he became a full professor of finance at the University of Chicago. Now, ladies and gentlemen, Raghu is an exceptional academic. He has done pioneering empirical and theoretical work across a remarkable broad field of topics. His main interests, however, lie in banking, corporate finance, and economic development, and especially in the role played by finance in economic development. In his paper entitled Financial Dependency and Growth, quoted with Luigi Zingales, he found evidence of a positive causality between the level of development of a country's financial sector and economic growth. According to Google Scholar, this paper has been cited more than 9,000 times. This is on par with Milton Friedman's influential 1967 presidential address to the American Economic Association on the concept of the natural rate of unemployment. Raghu's trademark is his willingness to challenge the accepted wisdom of the day. The best-known example of this took place at the Jackson Hole Symposium in 2005. There, he warned of an upcoming meltdown in the global financial system with substantial negative consequences for the real economy. Three years later, the global financial crisis broke out, and it was largely caused by the very factors that he had identified. For Raghu, financial markets play an important role for economic growth in the long run term. However, financial markets have a tendency to deviate from fundamental values. Financial regulation has therefore been a concern of his since well before the crisis. What are his recommendations in this regard? To be effective, regulation must avoid being procyclical, that is, overregulating in a bust and deregulating in a boom. Rather, regulation must be comprehensive and contingent. Consider two types of such regulation. First, instead of being required to raise permanent capital, institutions should arrange for capital to be infused when they are in trouble. One example of contingent capital is for banks to issue debt that automatically converts to equity under specified conditions. The second type of regulation is aimed at too big to fail institutions. Instead of limiting their size and activities, a more sustainable form of regulation requires these institutions to develop a plan that would enable them to be resolved over a weekend. Both of these measures, proposed by Raghu, have become fundamental elements of banking regulation in Switzerland since the financial crisis. Now, ladies and gentlemen, I have known Raghu for many years. From my personal experience, I can say with conviction that he's not only an exceptional scholar, but also an impressive policymaker. His career as a policymaker began at the IMF. In the aftermath of the 1997 Asian financial crisis, the IMF wanted to strengthen its financial expertise. And Krüger, then the IMF's first deputy managing director, asked Raghu if he would be interested in becoming the IMF's chief economist. Raghu replied, "Anne, I don't know any macroeconomics." However, this claim was neither convincing nor credible for the IMF's deputy managing director, and so, at the age of 40, Raghu was appointed as the IMF's chief economist. He was both the youngest ever person to be assigned this position and the first from an emerging market nation. During his tenure at the IMF, he pushed the research department to focus on financial sector issues and to explore ways of integrating them into the IMF's macroeconomic models. This was long before modeling the financial sector became a high priority both in academia and central banking. After his 3-year term at the IMF, Raghu returned to the University of Chicago. In 2012, he went back to India to serve briefly as chief economic advisor to the finance minister. In 2013, he was appointed as governor of the Reserve Bank of India, and in 2015 as vice chairman of the board of directors at the Bank for International Settlements. With hindsight, Raghu himself acknowledged that putting an academic in the governor's job at the Reserve Bank was like letting a kid loose in a candy shop. Which is not to say that the job was always easy and enjoyable. When he joined the Reserve Bank, inflation was at double-digit levels, the rupee was in free fall, capital was fleeing, and growth was weak. Raghu did not waste any time. In September 2013, on his very first day in office, he gave a press conference outlining a number of planned reforms. Investors and markets were soon convinced that the Reserve Bank would follow a stability-oriented monetary policy. However, there were also occasions when Raghu's comments had surprising consequences. For instance, during a press conference in 2015, when asked whether he was dovish like Janet Yellen or hawkish like Paul Volcker, he replied, "My name is Raghuram Rajan, and I do what I do." Of course, the next day, this James Bondish remark made headlines in the financial press. When his 3-year tenure ended, inflation was near the 5% target, thereby improving conditions for ordinary citizens. Interest paid by the government had been reduced, and bonds with maturities up to 40 years were being issued for the first time. The value of the rupee has stabilized, foreign exchange reserves were at record high, and India was the world's fastest growing major economy. Let me finish by saying a few words about one of Raghu's latest publications. Next to an impressive list of about 90 peer-reviewed papers on specific economic and financial topics, Raghu has also written 4 books with a broader perspective. In his book, The Third Pillar, How Markets and State Leave the Community Behind, which was published this year, Raghu emphasizes that society is supported by 3 pillars: the state, markets, and the community. Society can prosper if it achieves the right balance between the 3 pillars. Raghu argues that today these pillars are seriously out of balance. While states and markets have expanded their powers, communities have been left powerless in dealing with the consequences of technological change and globalization. As a result, people turn towards populist politicians. Their solutions, however, undermine the liberal market democratic system that has brought about prosperity. The appropriate solution to many of our problems consists of returning power from the state to the community. Communities should be able to develop policies to address their own needs. This makes them less receptive to populist solutions. Raghuram reminds me of the political system in Switzerland. Here, political decisions are taken at the lowest possible level of governance, closest to the people concerned. This decentralization fosters citizens' engagement in their communities. Now, ladies and gentlemen, today Raghu will speak about an issue that is more narrow in scope, but which is of great importance to central banks, not least to the Swiss National Bank. His speech is about the spillovers of monetary policy beyond a country's border. This topic has attracted a lot of attention in the past few years, following QE and other unconventional monetary policy measures adopted by central banks. Who better to speak to us on this subject than Raghu, with his profound knowledge of capital markets and his experience as the central bank governor of a country highly exposed to monetary policy decisions taken elsewhere. Ladies and gentlemen, please join me in welcoming Rajan with a big round of applause. Raghu, the floor is yours.
Thank you very much for that wonderful introduction, President Jordan. That was very kind. It's the kind of introduction my mother would like to hear every day. So I would love to send her a document reflecting that. This is a lecture, of course, in honor of Karl Brunner, a great monetary economist. And I was trying to think of links between what I'm going to talk about today and his work. He certainly was interested in the connection between money and credit. And that's what I'm going to focus on today, both within a country as well as spilling over across borders. Now, I know there's a sizable contingent from my home country, and you know, for you, I have to say this is a more general lecture on economics. And if I don't talk about India's economy or monetary policy, apologies, and I'm sure there will be time to talk about that later. I also want to complete that dialogue with Anne Krieger. When I said, Anne, I don't know any macroeconomics, she replied, don't worry, that makes two of us. So Anne was a wonderful boss at the IMF, but she clearly knew far more than I did. At any rate, what I want to talk about is really the connections. This is something I've been trying to work on for a number of years, and as with all academic projects, you sort of get closer, but you're not quite there. And you'll see why I say I'm getting closer, but I'm not quite there. And the project is to understand if there are any connections between monetary policy and the credit cycle, something that, for example, Claudia Borio has done an enormous amount of work on, and to try and establish those links in a more theoretical way and eventually in an empirical way. And you will see that the connections are not cast iron. There are links. And over time, the hope is we understand what those connections might be, both in the positive sense of enhancing credit, but also in the negative sense of weakening the quality of credit. And that's what I'm going to talk about today. The starting point for this thinking comes, as Thomas said, from my own experience with being in an emerging market. And I call this the multilateral non-system because a system implies a lot more logic and rationality than actually exists. It used to be a system because the idea was that with every country allowing its exchange rate to be flexible, it had the freedom to conduct an independent monetary policy. And the exchange rate was the buffer that buffered a country from the effects of other countries' monetary policies, right? And so long as you did what was appropriate for your own country, kept your own house in order, you were fine. And the world system worked quite well. Yet even with this kind of thinking, we've had repeated crises. And it used to be the crises were in the emerging markets, so the view was, okay, you guys don't know how to run your system. That's really the problem. It's not a problem with the system itself. But then we've seen that even industrial countries, countries like Ireland, Spain, have gotten into trouble as a result of cross-border capital flows for a variety of different reasons, not necessarily the same ones as emerging markets. And it seems as if in this world we don't really know how to handle the volatile cross-border capital flows that are coming. They create fragilities. And there is some sense, and this is something that John Taylor talked about in the last Karl Brunner lecture, that monetary policy in source countries does seem to have an effect on these cross-border capital flows, and a large literature has worked on documenting it, but also that it has effects on exchange rates, which is something that he focused on in his previous lecture. Now, the debate here is really one side. Just to make the point, let me focus on Ben Bernanke, though I think he represents a large group, which basically says that the problem in this non-system is really that you're not playing by the rules, that the emerging markets don't have a sufficiently flexible exchange rate, and they may do that maybe because they're seeking a competitive advantage in selling their products. But for whatever reason, that's the reason they get into trouble, because they're not letting their exchange rate move appropriately. And then there's a counter view from a variety of people, including Helen Ray, that flexibility is not the answer, and it will not restore monetary and financial independence, unlike the own house in order argument, that there is a global financial cycle driven by US monetary policy, and this creates changes in risk aversion, changes in risk premia, which tends to affect receiving countries, right? So what I want to do today is start with this, but explain why the exchange rate is an inadequate buffer. And in fact, allowing flexibility may actually exacerbate the financial cycle in a country. And in this kind of environment, the receiving countries will experience the effects of adverse spillovers, including a boom, as well as a sudden stop or bust. And it may be partly because they don't have deep financial markets. That I will certainly admit. But I think putting the entire blame on inadequate regulations or inadequate institutions is probably overstating the case, because you have similar but more muted phenomena in industrial countries. So I want to start with a model which is entirely in an industrial country to explain why this may happen and why you can see a financial crisis emerging even in an industrial country, but why the spillover effects into countries that receive capital flows can be significantly more. Okay? So this is a quick plan for the talk, so you know where we are. And I want to start with some empirical observations. This is not to establish causality, it's just to say, look, there are some things that seem correlated. Let's try and offer an explanation, and then we can go test it more carefully. I want to talk about the problem of high anticipated liquidity in a domestic setting. And I have a very specific definition of liquidity. You will see what it is in a short while, but it's important. And I will then translate a model which is entirely located within a country to understand what happens when the exchange rate also moves. Now, this is sort of finger-lifting economics. I don't have an entire consistent macro model. You will see that I'm sort of doing the translation almost literally. But let me try and explain how seemingly aberrant EM behavior makes sense in this setting. Why what Ben Bernanke complained about emerging markets intervening may actually be the right thing from their perspective. And it's not about a competitive advantage, but it's about financial stabilization. Intervention is a macroprudential measure in this kind of environment, preventing a more deep crisis. And then I'll talk about alternative policy measures. That's how I will end. So here's the kind of observation that people at the BIS, people elsewhere look at and say, maybe there's a correlation between monetary policy and financial conditions. This is the IMF's Financial Condition Index. And what you see is, 90s, it's pretty flat. And then starting in the early 2000s, it becomes very, very liberal. So very accommodative financial conditions. Up is more liberal. And you see a lot of easing just before the financial crisis, then a significant collapse. And then again, post-financial crisis, we are in an environment of significant financial easing, right? And when you look at this kind of easing, I often like to point to this work by Maddaloni and Pedro, which looks at what monetary policy should ideally have been and tries to correlate it with lending officer standards. Now, many of you have heard of the Taylor rule. It's an attempt to try and say what reasonable monetary policy should be. Lots of controversy of whether it's the right way central banks should behave, but it's one measure of how they should behave. And when Taylor rule residuals are negative, it means that policy is a little more accommodative than the Taylor rule suggests. And when they're positive, it says that policy has moved in a tightening direction. So the dark line is the Taylor rule residuals for the euro area, and it's suggesting that right till about the fourth quarter of 2006, the ECB was actually had negative Taylor rule residuals. So it was more accommodative than would be suggested by the Taylor rule, right? And then it switched in 2006. If you look at lending officer standards, whether loan standards are being tightened or loosened, you see that has a lag with respect to monetary policy. It still is loosening and eventually starts tightening in 2007. So those who argue there's a link between monetary policy and credit would say monetary policy was a little too loose until 2006 end, and then credit followed a little after that, but if there was a correlation, that might suggest that monetary policy had some role, and credit was too easy for too long. You can see something similar for the United States. This is a longer period over which this is plotted, but again, the dark line is a Taylor rule residual, and what this is saying is even in the US, residuals were negative till around 2006. And similarly, lending officer standards tightened soon after, but followed after monetary tightening. So by this measure, obviously there's no causality established, but just by correlation, there's something to explore here, right? Between monetary policy and credit standards. Now, let me just offer the caveat. There's a big debate between John Taylor and Ben Bernanke on these Taylor rule residuals. Ben Bernanke will argue they were not negative and the Fed was okay, it wasn't behind the curve. And John Taylor says they were. This is a back and forth. I can point you to the debate between them, but I just want to say that I've picked the kind of graphs that I like. There are obviously alternative descriptions. So what are the consequences of these easy financing conditions? Well, Claudio, along with the current governor of the Reserve Bank of Australia, Philip Lowe, established the correlation early on between high credit growth and rising asset prices and said this was particularly damaging when you had this correlation because it typically signaled the advent of a crisis. And more recently, a number of papers look at froth in credit markets and argue that when you look from the vantage point of a crisis and look back, you find that credit growth and credit spreads are negatively correlated before the crisis, but then as the crisis hits, credit spreads change considerably, and that tends to predict subsequent output declines. So here's a picture of that. What you see out there is the path of credit spreads. They stay relatively low for a long time, even while credit is building up. So it's not that lenders are demanding more compensation for the risk, even as leverage picks up. But just before the crisis, it seems as if they seem to recognize that things are turning bad, and so they start demanding a much higher spread. And of course, this could be part of what precipitates the crisis because it becomes much harder to roll over debt at that point. So there's a period of extreme complacency when lending is happening, and then a period of tightening as you get near the crisis. And of course, it has large effects on GDP. So why does leverage increase and why do spreads decline? Why does the real recovery, as you can see here, the GDP path is negative for a substantial period of time. Why does the real recovery take so long? And what role do easy liquidity or easy financial conditions play? So we need something which keeps the recovery from happening for some time. That's what I'm going to try and talk about, why easy conditions create the underlying sort of environment in which when there is a crisis, it takes particularly long to recover. Okay, so that's really the objective of this. So let me start by, this is based on work with Doug Diamond and Yanzi He, a student of ours. And the idea starts with first defining what liquidity means. Now, there are very many definitions of liquidity, but the idea we have in mind is liquidity comes when the buyers of very specific assets have a substantial amount of money they can call upon, right? So in the case of real assets, like if the real asset's a small, easily tradable asset like a corner grocery store, there are plenty of people who can buy it, there are plenty of people who can finance it, it's fairly liquid. If you take a nuclear power plant, there are about 5 firms in the world who can actually know and operate a nuclear power plant. So what matters is what kind of liquidity they have, what kind of access to finance, what kind of reserves, what kinds of capital they have, because that determines how much they will pay in that particular market, right? Similarly, what we saw is during the global financial crisis, there were lots of complicated financial assets. Those assets typically have a somewhat restrictive market, essentially entities who understand that asset and can hold it. That's a small number of entities. When those entities have limited capital, limited wealth, limited access to funding, those assets plunge in value because the people who know how to buy them and use them essentially can't pay for them. They don't have enough funds. So what I'm going to talk about here is generally specialized assets, and argue that liquidity is the buying capacity of expert buyers, their net worth or access to financing. And this is an idea popularized by Schleifer and Vishny. So I'm going to argue that in a world where the buyers of assets are expected to have plenty of wealth going forward, that the assets are going to retain high value because these people can make high bids for those assets. That's going to do a number of things which make this subsequent downturn, if it ever happens, much more harmful, much worse than in a situation where liquidity was much lower. In other words, liquidity makes the environment much more complacent in a particular way, you will see, and as a result, makes the system unable to deal with a situation where the liquidity has disappeared. And as a result, the downfall is much deeper. So that's what I want to work on, and for that, all economic models are stories. So I want to tell you this story and put some thought behind it. Think of a firm. So what I want to do is explain how much leverage a firm takes on, and how that leverage, as well as the actions the firm takes, depends on the liquidity environment. And I want to argue when the liquidity environment that is expected in the future is particularly promising, it makes, first, the firm take on much more leverage, and second, makes that leverage much less sustainable in the longer run if the liquidity disappears, for a reason I will come to in just a second. So a firm is put up for sale. A number of expert managers bid for the firm. These are the guys who know how to run the firm. Think of these as the BlackRocks of the world who know how to manage those complicated assets, or the Westinghouse who know how to run the nuclear power plant. So these are the experts who can bid for that complicated asset, the firm. The highest bid depends on how much debt financing each bidder can get. And let's call the winning bidder the incumbent manager. Now, lenders to this incumbent manager for that bid aren't stupid. They're going to lend only if they expect to get their money back, right? So we want to understand how much they will lend, and how much they will lend will depend on how much they can recover. And that depends critically, as we will see, on how much the firm's assets will sell for in the future. So how much can lenders recover? How much payment can they enforce? Well, it depends on how they enforce payments. Now think about how lenders typically enforce payments. One is, if you don't pay, what did the old pawnbroker do, or the old money lender? They seized the asset and went and sold it in the market, right? That historically has been the way that debt can be recovered, by taking the asset away and selling it and recovering on that. So a lot here depends on how much they can get if they sell the asset. Think about, for example, a house lender in a booming housing market. They have no problem lending. If you don't pay, they'll just take the house from you and sell it to the next guy. And given the housing market is booming, they may even make more money on it. So lending is very easy when you can recover by seizing and selling the asset. Now, unlike a house, this is a more complicated asset. There are fewer buyers in the market for this. So what matters is how much wealth those potential bidders have, how much wealth the potential experts have. And in a boom where you expect them to be very wealthy, you expect it no problem to sell the firm, because those guys have plenty of money to bid. Now, so in an environment where you expect a lot of liquidity in the market going forward, lending is very easy. You lend knowing that assets have high value, and recovery is going to be very easy because you're going to seize the asset, sell it to somebody else who has the expertise, and they have plenty of money to buy. So this is one method of recovery. The second method of recovery, this is more normal, right? Typically, the old pawnbroker method of recovery is only when you're likely to default. And in more civilized environments, what happens is the lender, the bank, can recover simply because they know you have generating cash flows. And those cash flows, there's a whole accounting system which makes sure they can't run away with the cash flows. There are tight covenants. There's a whole governance system which makes sure that the cash stays inside the firm and is available to repay lenders. So in this kind of environment, the alternative method of repayment is for the firm to be able to pledge its future cash flows to the lender by putting in place governance systems. Now, for those of you who think this is entirely normal, it's not always normal. If you were in Russia in the early 1990s, when Russia was moving from a communist economy to a more Western economy, what you saw was many companies where you had no idea what cash flows were. You had no idea where the cash flows were going because they came in as revenues, they went out through the back door somewhere else. So in an environment of relatively poor governance, in an environment where you don't have strong accounting, it is not a given that the firm will essentially have the cash flows it generates to pay out to the lenders. So this requires work. It requires work to improve the governance practices in the firm. It requires work to improve the accounting practices. It requires work to close down alternative ways that income can be tunneled out of the firm. And this is something that faces every young firm inside the economy because it has to establish these practices, good accounting practices, good ways of ensuring the cash flows are accounted for and go to pay lenders. So I'm going to call this form of improving governance pledgeability. So what we have is two ways lenders can get cash. One, if they can seize the assets of the firm and sell it to somebody else. And two, if the firm itself improves the pledgeability of its cash flows by adopting good governance mechanisms and thereby can send the cash back to the lender. Okay? Now, this second set of actions to improve your debt, your ability to borrow, depends on actions by the firm manager, by the incumbent firm manager. There are always ways that the firm manager can undercut past governance practices and reduce the quality of governance within the firm and thereby misappropriate the cash flows. That is something that can be done, is often done in many emerging markets and developing countries, and also occasionally in industrial countries also. That is a possibility, and so I want to allow for that possibility also. So two ways of promising to pay back. One is by increasing, by seeing high liquidity in the future, and the second is by improving the pledgeability of cash flows. Both these will imply that I can borrow more today. Now, that should be pretty obvious. The point is when they combine together, they increase leverage even more. If I know that liquidity is going to be high in the future, and also I work very hard in making my firm well-governed and the cash flows properly accounted for, lenders are willing to lend to me, right? And because the lender can recover a lot in the future, it is willing to lend a lot up front. Okay, so both these will increase leverage up front. Now, the bottom line so far is a long, sort of drawn-out process to say two ways of increasing borrowing capacity for the firm. One is outside, driven by the liquidity environment. And the second is from within the firm by making the firm essentially more collateralizable, more pledgeable, and being able to borrow more against it from the wider financial market. Now, the two modes interact. They interact because ultimately, how much is any bidder going to be willing to pay for the firm in the future? Not more than the fundamental value. So if the bidder has enough money on their own and doesn't need to borrow any more against the firm's assets in the future, that's enough. And knowing that bidders have enough money of their own, as an incumbent firm manager up front, I say, there's plenty of money in the markets. I don't need to work on increasing pledgeability so as to preserve the asset value and the borrowing capacity of the firm in the future, because the wealth in the market is enough. In other words, these two both enhance debt capacity, but because I know that beyond a certain point there's a limit to how much I can borrow, if in fact liquidity is enough to get that borrowing, I don't focus on maintaining the debt capacity through this increasing pledgeability, right? So an important point to understand is high future industry liquidity reduces the need for firms to maintain governance, to maintain access to the debt markets by ensuring that their cash flows are clear and well-defined, and that investors have confidence that those cash flows will be available to repay debt, because there are plenty of buyers available in the debt market. Let me give you an analogy just to make this completely clear. In the housing market, if in fact I can repossess the house quickly and sell it in the market for full value of the loan, I don't need to do any due diligence on you when I lend to you. I don't need you to have an income. I don't need to establish that that income, some of it will go to repay my debt, because just the ability to repossess the house and sell it is enough to recover my loan. In other words, liquidity tends to crowd out internal governance, if in fact it is at a sufficiently high level. Okay? Now, the key, let me skip over this and go to the next thing. So in this kind of environment, and this is the entire model, so it's not going to get any more difficult than this. We said up front, there's a buyer for the firm who bids for the firm after winning the auction. Now, this buyer borrows as much as they can. They borrow because of two reasons. One, they can set pledgeability so as to encourage lenders, because lenders know the cash flow will be available to pay them if they set pledgeability high. And they also know there's liquidity in the markets. There are potential buyers who will have their own wealth to pay for bidding for the firm. When you combine both the fact that future buyers can borrow against the pledgeability and they can also borrow using their own funds, that means they can bid a higher amount for the firm, which means higher recovery, which means higher leverage upfront. Okay, so that's the net effect of what we've talked about. Now, all this relies on incumbent managers increasing pledgeability after they've bought the firm, right? Actions of the managers matter. They have to essentially be able to commit to increasing pledgeability. Why would anybody want to increase the pledgeability of cash flows after borrowing, knowing that one of the effects of increasing pledgeability is essentially going to be to increase the bids for the firm and make it easier for lenders to recover their money? Why would I want to give a freebie to lenders by improving my own corporate governance within the firm? And the answer is, any firm which wants to raise money, or any firm where the manager wants to sell the firm at some point, has an incentive to increase pledgeability, because regardless of the fact that they have debt, they also may want to preserve the right to raise finance if they have new projects, or if they have to sell the firm because of an unexpected eventuality. So given that, there is an incentive for an incumbent manager to increase pledgeability. However, they face a trade-off. If they increase pledgeability, if they increase the internal governance, they can certainly sell the firm for more when they have an eventuality which warrants selling the firm, but it also implies that they have to pay financiers more, having taken on the debt. So they have this trade-off. And how does the trade-off play out? Well, higher the outstanding debt they have, lower their incentive to increase pledgeability. The more debt they have, the more anytime they increase pledgeability, they're increasing what they pay the creditors. And that's a bad thing from their perspective. So there is what many of you may have encountered if you work in corporate finance, something called a debt overhang. If the firm takes on sufficient debt, it doesn't do the right thing. Because creditors own much more of the firm, there is an under-incentive to do things that benefit the creditor. In this case, it's an under-incentive to preserve the quality of the cash flows. There is an incentive to whisk the cash flows out through the back door rather than pay it to the lenders. So higher the outstanding debt, lower the incumbent's incentive to increase pledgeability. So what we have is these interactions already. First, higher liquidity encourages leveraging upfront. Why? Because lenders can get paid more easily when there's a lot of liquidity. The firm's value is bid up, and therefore lenders know they can get their money back. They're willing to lend more upfront. Second, higher liquidity diminishes the need for pledgeability. Why? Because there's a maximum that borrowers, that the bidders will bid for the firm later on. And if there's plenty of liquidity, why rely on pledgeability? You can bid fundamental value just based on the funds that you have. You don't need to borrow anything more. And the third effect is the one at the bottom, which is that more borrowing up front diminishes the incentive to raise pledgeability for the reason I just talked about, because you know if you raise pledgeability, lenders can get more back. That comes at your expense. So the benefit of selling the firm for higher value is diminished by the fact you have to pay a lot of it to the lenders. You don't want to raise pledgeability that much. Okay, so these are the interactions. And again, what this means is upfront, if there is a lot of liquidity here, I know the economy is going to be very liquid, that the expert bidders are going to have plenty of wealth of their own, and this is a high probability event. The economy is going to continue to be in a liquid state. Then it does two things. One, upfront, when anybody is bidding for the firm, they can borrow a lot. They can borrow a lot because lenders know this is the most likely situation. There's a high probability of having high liquidity, and therefore they're willing to lend a lot, okay? But there's another problem, which is when I borrow a lot, I set pledgeability after I've borrowed. And with all this borrowing, I may actually have a very low incentive to enhance pledgeability, to improve governance. I neglect that aspect. Put differently, in the midst of a housing boom, the lenders neglect to worry about income. This is where they make ninja loans. No income, no job, no asset. They make loans to people like that because they don't have to worry about it. The value of the asset itself is enough to take care of repayment. So here again, you have similar phenomenon. This implies high leverage. High leverage implies that corporations don't have an incentive to maintain alternative sources of borrowing going forward. It is enough that the market is liquid. They know that they can repay their credit. They know they can borrow some more at that point. They don't worry about that. So all that is fine. All that is fine, except that even though this is the high probability event, you could end up here. You could end up in 2007, 2008, thinking that liquidity will be plentiful, and suddenly it dries up. Now, if liquidity dries up, if the natural lenders, the natural buyers of that asset at this point have very little wealth of their own, the BlackRocks of the world don't have sufficient access to finance that they feel they can bid high prices for complicated assets, then it is important that those assets have an alternative means of debt capacity, that firms that rely on that kind of buyer allow that buyer to borrow against the firm itself. That requires high pledgeability. But in the run-up to the crisis, you have neglected pledgeability because you didn't need it then. And as a result, you're up a creek without a paddle at that point because you let the paddle float away in the lead up to the crisis. because you thought liquidity would take care of everything. You didn't have the need to enhance pledgeability, and the high leverage that you took on, in fact, dissuaded you from maintaining this alternative source of borrowing. So this is the sequence: high probability of high future liquidity, high capacity to repay debt, even neglecting pledgeability, more borrowing available upfront to buy the firm, higher prices bid for the firm upfront, higher leveraging of the economy, but it does have an adverse effect. You don't keep up pledgeability, and if liquidity disappears, you really have a plummeting of debt capacity. And that could explain the Krishnamurthy and Moore finding that in the run-up, because you're relying on liquidity, spreads are low. And then as you start recognizing liquidity may disappear, spreads start mounting because you fear that there is a possibility it might disappear. And in the crisis, when liquidity totally disappears, debt capacity plunges. These firms have no ability to roll over their debt simply because it was based on a promise of liquidity which no longer is there, and they're dependent on something which they have neglected, which is pledgeability. So the dynamics are: in a boom, you have rising leverage, falling spreads as expert liquidity increases, and debt becomes safer. Eventually, rising spreads as pledgeability is neglected and debt becomes riskier. What it means also is, over this period, financial fragility increases because you're dependent on a narrow set of experts. You're dependent on the BlackRocks of the world in having sufficient finance and sufficient wealth to bail out the system, to buy those complicated assets, which nobody else knows how to price and how to buy. And if, in fact, they don't have that, the value of those assets plunges, and that's when the government comes in and bails out the system, right? So downturns in this is when the anticipated expert wealth doesn't materialize, liquidity-based debt capacity falls, and as pledgeability has also been neglected, pledgeability-based debt capacity also plummets, debt capacity plummets, hard to roll over debt, you're in a full-fledged financial crisis. Credit squeeze, and this can be a prolonged credit squeeze, because in order to rectify it, just pumping in liquidity will not help. It has to be liquidity in the hands of the right buyers. And second, if you want pledgeability also to kick in, it will take time because you have to improve corporate governance. And that takes a fair amount of time if you want the firms to be able to borrow again. So debt capacity stays low until pledgeability is raised or industry liquidity rebuilt, both of which are long-dated phenomena. This is why the crisis in this environment can be pretty long. Testable implications. Now, so far I've talked about within country. I'll come in just a second in the spillovers. But the testable implications is that your focus on things like corporate governance is going to fall off as high liquidity persists, especially in industries undergoing a boom. And when liquidity dries up, you're going to switch back to focusing on improving corporate governance. So here's an example of what this is like. This is a paper by Lisowski, Minnis, and Sutherland. They look at the construction industry in the run-up to the crisis and beyond. Now, construction industry was the one which went through a significant boom during the crisis and then a bust, right? So this is something where, before the crisis, the promise of liquidity was high, and after the crisis, liquidity dried up. What you see is exactly what I suggested, that these construction firms, in their borrowing from the banks, the number of firms providing unqualified audits to their bank, in other words, saying that their accounting was correct, kept falling in the run-up to the crisis. They weren't keeping their house in order because there's plenty of liquidity. The bids for construction firms were high, the bids for land was high. They didn't have to worry about preserving corporate governance. And so corporate governance quality deteriorates relative to other industries, for example, that were not subject to the same kind of boom. But after the crisis, as the crisis hits in 2007, 2008, they see the light and start improving the quality of their accounting, improving the number that, and you can see this a little more sharply in the difference between the two industries. The quality of accounting plunges in the construction industry relative to the others, but post-crisis, as the crisis starts hitting, it starts moving back up. That's an example of what I have in mind, that liquidity tends to crowd out pledgeability, especially when it's very high, but it tends to be accompanied by leverage. As liquidity is enhanced, leverage increases, and therefore the consequences of lower pledgeability are particularly damaging when that liquidity disappears, because there's nothing to hold the firm's debt up. Okay, so let me skip past the related literature. There's a lot, but let me translate to the cross-border setting, just to give you an analogy of why this can actually be exacerbated in the cross-border setting, okay? And let me just add 3 ingredients, and then you'll see what in this kind of model. Let the domestic economy that I'm talking about be the capital receiving economy. It's an emerging market. And let the domestic experts be firms with some dollar borrowing, okay? So when we have easier US monetary policy, it gets transmitted over time into domestic currency appreciation. Okay, this is what John Taylor talked about last time. When US monetary policy eases, the receiving country for capital flows, because capital flows out of the US into the receiving countries, the currency for those countries appreciates. Now, the source country, that is the US, I'm going to say US just to make things simple, the US has adverse shocks in its own country. It reacts by cutting, by going to accommodative policy, and that stays low for long, something that Claudio and Bill White point out. So in this kind of environment, the chart that I put earlier gets transformed a little. When you have easier source country monetary policy, you have steady currency appreciation anticipated in the receiving emerging market. It's receiving capital flows in the sense that the currency will appreciate, which then means that domestic firms that have borrowed in dollars now see their net worth increase because they have to repay dollars, but the domestic currency is worth more, and therefore the net liability falls in value, the net equity goes up. So think of this as a form of liquidity being infused into the expert firms. They have higher liquidity because they have borrowed in dollars and the dollar value of the liability is falling. They have spare debt capacity. They have spare borrowing. So they're willing to bid higher prices for firms that come onto the market financed with higher debt. Why? Because they have a greater ability to bid. This is the effects of liquidity. So liquidity then enhances leverage. And as this becomes a boom, that leverage tends to reduce governance inside the economy, okay, inside the firms in the economy. And which then, over time, as the firms in the economy lever up, it makes the economy susceptible to a reversal of source country monetary policy. Because if that reverses, it's as if liquidity got taken away. Because exactly the opposite happens. The guys who borrowed in dollars now have lost a huge amount of equity. And in fact, it looks as if they have very little liquidity. And everything that we talked about earlier goes in the reverse direction. Okay? Except they've borrowed, but they haven't maintained corporate governance. If you remember, post-Asian financial crisis, one of the biggest concerns were a lot of firms that had borrowed money were very poorly governed. Well, it's a consequence of the availability of easy liquidity. It tends to diminish the care that lenders take to governance and diminishes the willingness of firms to improve governance because they have so much external leverage. And both combine in order to make the crisis much worse. So let me skip past this, we can come in the... there are a number of papers that correlate with this kind of explanation. For example, Grinchas and Upsfeld argue that crisis episodes are preceded by significant buildups in domestic credit and large real currency appreciations. That's sort of consistent with the idea in this model. The paper in 2018 suggests that firms with higher outstanding foreign debt before an exchange rate appreciation take on more debt, consistent with the view that that frees up more debt capacity. These are the experts. They can bid more than for assets, and leverage in the economy picks up as these guys bid more and take on more leverage themselves. And finally, Browning and Ivashina look at the other side. When the source country monetary policy tightens, the effect on credit is very sharp because essentially liquidity reverses completely, and as a result, the effect on credit is sharp. And they argue that this affects both foreign and domestic credit. Now, if you thought this was just a panic by foreign creditors, it should just affect foreign creditors. But in my model, it doesn't matter whether you're a foreign creditor or a domestic creditor, debt capacity falls. It plummets because liquidity is no longer available and you've neglected pledgeability over this period, and therefore debt capacity falls a long way. And that's why it's not just a fall in dollar debt, it's a fall both in domestic debt and dollar debt, essentially a total fall in debt capacity. Let me only say that as far as models of irrationality go, there are models of irrationality which can explain crisis. I think I would be happier with a model of rationality that explained crisis and then add irrationality on top. And this is a completely irrational model. Lenders are doing the right thing. They're lending more, even though they know it's risky, because they know there's plenty of liquidity to support the lending. Now, there is a small probability that liquidity doesn't emerge, in which case you're in deep trouble, but they account for that in the spreads that they ask for. So low spreads for a long time, then sudden pickup in spreads as they understand things are getting riskier. But when the bad stuff happens, the spreads increase considerably more, and that's when the real problems come for the financial sector. Now, we can overlay irrationality on this. I'm not denying that there is irrationality in markets, but you don't need it to explain this kind of problem. So why does aberrant EM behavior make sense in this kind of setting? There's been a long literature talking about the fear of floating, why EMs don't like things that make the exchange rate move, why they're reluctant to let the exchange rate float easily. And one example is emerging markets intervene in the exchange rate to slow appreciation by building reserves. But as evidence that this is not to seek a competitive advantage, they also spend the reserves in order to slow the depreciation. They want less volatility, right? And why is that useful? In this model, it is useful because it prevents the sharp increase in liquidity and the sharp fall in liquidity. It makes it much more smooth. And that's a good thing because it prevents the leveraging, and the prevention of leveraging prevents the decrease in pledgeability, which becomes the ultimate source of the crisis. So the intervention here is a macroprudential intervention. It's not meant to gain competitive advantage. And Ben is right that EMs intervene, but allowing for full flexibility could exacerbate the boom and the bust. So, there's a lot of talk about currency wars in the early part of this decade. That was about competitive advantage, about deindustrialization. But I think there's an equally compelling argument for intervention in the currency, and that's about preventing financial imbalances from building up and preventing financial fragility. Now, there's a wonderful paper by Hoffman, Shin, and Villamizar Villegas, which shows that sterilized FX intervention dampens capital inflows, but more to our model, sterilized FX intervention in an emerging market has a strong dampening effect on domestic bank lending. So it does prevent the buildup in leverage. You operate on the exchange rate, it does prevent the buildup of domestic leverage. Now, there are obviously adverse consequences of intervention. The macro consequence is it prevents the exchange rate from adjusting, and of course, the own house in order idea that we started off with. But in the narrow context of the model, it could also exacerbate borrowing by the corporations. And this is something that we saw again and again in India. If you intervene to stabilize, the corporation believed the central bank would bail them out and therefore took more foreign currency loans. Well, the problem is once you intervene, you have to do other interventions also. It's never clean. And so the intervention, both in India and China, is to limit foreign currency borrowing by corporations. That's a macro stability intervention. It's not pretty. It often becomes messy and ugly. But it is a way that you can both stabilize the currency, but also prevent firms from taking on too much foreign currency borrowing and putting the burden of adjustment on the central bank. The bottom line is there's no clean solution in these interventions. A lot of it is about muddling through. Is that a good thing? No. But it's probably the third best alternative that we have, given the first and second best aren't available. And finally, let me spend 2 minutes on solutions. First, can we do better through multilateral cooperation? Well, multilateral cooperation has many, many tones, and I don't want to push too hard on it, but it would be useful to recognize there's a problem. That, in fact, there are these spillover effects. The historical phrase is attributed to John Connolly, "It's our dollar, your problem." I think we see that, at least in the past, it was the tone. It's our monetary policy. We have a domestic mandate. So what if you have a problem? Over time, it has expanded to, okay, we understand you have a problem. We can still respect our mandate and look at spillback effects. How it affects you, but in the way that it affects us is what we'll take into account. Now, spillback effects don't take into account the full effect, because what matters is how it spills over to the rest of the world rather than how it spills over and then spills back to you. That spillback can be relatively small. Another source of argument that's voiced sometimes is, you emerging markets are nuts. You complain when the money flows in and you complain when the money flows out. Make up your mind. Well, it actually is a problem both ways. When it comes in, it exacerbates leverage and asset prices. When it goes out, it creates a crisis. So, in effect, emerging markets are really being forced to choose about how much foreign capital they can use. They do need foreign capital. You do need foreign capital because often it's the only risk-bearing capital that's available. But if you have to accumulate a significant part of the capital flowing in as reserves, in order to reduce the exchange rate volatility on both sides, it has much less benefit than it could possibly have. You're sending out a lot, holding it in liquid, low-return assets in industrial countries in order to get some risk-absorbing capital internally. This is not an ideal exchange. We should be able to do better than this. And of course, a third problem is that today, in the environment where nationalism is rife, intervention tends to be misinterpreted, and this is something that is of growing concern. So I think we need to first understand there's a problem before we decide on solutions. Second, we need to understand what actually happens. And I've given you a model. I can immediately point to some, difficulties in the model itself. I haven't linked the model to monetary policy. I've called something liquidity and said that it could be enhanced by monetary policy, but that's an indirect argument. And what I have to do is work harder, which I'm doing in further papers, to try and establish that link. But there's lots of empirical work now, far better in documenting spillovers than they used to be 5 years ago. So the work is going on, we're learning more, and we should be able to understand what kinds of policies might make sense. And as with climate change, we have to figure out, okay, once we understand what the problem is, what kinds of solutions? And the typical, can we avoid the problem? Can we mitigate the problem? Can we adapt to the problem? Those are things we need to think about. So in that vein, what can sending countries do? Well, sending countries basically say, this is not a problem, we have a domestic mandate. Now, that domestic mandate is not God-given. It is possible over time to think in an integrated world whether large reserve country currencies should in fact continue to have only a domestic mandate. Maybe the answer is yes, but maybe the answer is there might be a better way, a domestic mandate plus, for example. And some of us have suggested that perhaps there should be rules of the game. Ordinary monetary policy, no questions asked. But if you start embarking on extraordinary monetary policy, perhaps we should look at these spillover effects and see how long these extraordinary monetary policies should be continued, or when they should be re-examined because of their extraordinary spillover effects. John Taylor argues that many of the problems would be resolved if you followed ordinary monetary policy with specific rules. The point is there are lots of arguments that perhaps some rules of the game could benefit. Are international rules likely in the current populist environment? Of course not. There is no mandate, no appetite for international cooperation, let alone any kinds of constraints placed on existing policies. However, I would argue that even attention within a country to the effects of monetary policy on the domestic financial sector, looking at that kind of spillover could perhaps move monetary policy in a direction that mitigates some of the international spillovers. And in this, I think, this is something that the BIS has also been talking a lot about. Lastly, I mean, on this vein, I would say, look at the IMF Financial Conditions Index, and look at the rise of covenant-light loans. These are loans that have no protection for the lender. Look at the rise of covenant-light loans, and this kind of correlation would say that perhaps if the US was worried more about what was happening in the domestic markets, it might worry a lot about maintaining conditions easy for long. And in fact, I would argue in 2018, one of the factors prompting the normalization of policy was the worry that too low for too long could create financial excess. And both the Fed chair as well as the former Fed chair talked a lot about leveraged loans as being something that they were getting increasingly worried about. Unfortunately, since then, for a variety of reasons, monetary policy has backed off, perhaps rightly so, but it is something that if central bankers kept in mind when they set policy to keep inflation in control, they also kept in mind financial risks, perhaps there would be fewer spillovers. A version of the own house in order, but with an expanded mandate. And finally, this is just showing that those IMF financial conditions also correlate with capital flows into emerging markets. So if you just focused on the risk to your system, perhaps you would also limit the excess flows into EMs. The receiving country also has some duties. Certainly what they've done so far is intervention plus reserves. Some have adopted capital flow measures. I did when I was at the central bank. But really the longer term response has to be deepening your capital markets, increasing their ability to absorb capital flows without substantial price changes. That would limit so much the volatility. And finally, there's a role for multilateral institutions. Certainly, research is obvious, but I think this is something that we need more of, an impartial and unbiased assessment of policies. And over time, if we can get more of a certainty about what rules to apply, that might be useful, as well as finally, reliable liquidity facilities without stigma to help when, in fact, these capital flows start flowing out. Now, let me finally end with an advertisement. A number of us were part of the EPG report submitted to the G20, and some of these ideas are embedded in that report. Let me stop there, and happy to take questions. And thank you for being such a patient audience. I have explained a true academic paper to you. So if you're not an academic, congratulations.
Well, thank you very much, Raghu, for this really brilliant lecture. I think we have learned a lot today. As usual, when you are lecturing, I think the very important concept of liquidity, of pledgeability, and of leverage were very well explained, and especially the context from a national context over to an international context, and that could be then a reason for really spillovers and big changes in exchange rates. So this is, I think, very important, and you showed also impressively how important it is to well understand the problem before we can find reasonable solutions. So thank you very much again, Raghu, for this brilliant lecture.